to do adjustments for those $1,500. Maybe you're going to pay another $300 for those intangible non-current asset within the listed company as well. And maybe you can also argue that, well, is this $1,500 would relate to the true value of this listed company? Well, maybe the answer for that is no, because the market value of this $5 here may not reflect some of the information that has not been announced to the marketplace. Because in most of our stock exchange nowadays, we are in the semi-strong form, market hypothesis. This means that the market value of this $5 here will only reflect the past and the current information of the company. So past information will be related to the management that we've bought into the company before, and the current information will be related to the current financial figures within the financial statements of this company. But what about for the future plan the company is going to announce? For example, if the company is going to enroll in the future plan of investing their money into buying the new factory, they can earn additional $3 million of cash. And if this is the case, from the business analyst perspective, we also need to take into account those figures into valuing a business. We are not just focusing on to the past and the current situation of the business, but also we need to adjust for any of this future prosperity of the business. Because we buy this company, the reason being we would like to have the future prosperity of our money coming back, rather than we just spend the money away and we get nothing out of it. So that's the reason why we're going to value a business. So the business valuation, firstly, we're going to talk about the reasons why we're going to value a business. For example, we'd like to buy another company so that we're going to value it. Maybe we're going to list a company onto stock exchange and determine the share price the company is going to issue, or we can call it the selling price. Or maybe you can argue that the reason why we're going to value a business is because we're going to adjust the current share price of the company, because we are in the semi-strong form, market hypothesis nowadays. We've got limited amount of information. That's the reason why we're going to adjust for that. But the question is, how are we going to value it? So we're going to talk about the ways or techniques that you can use into valuing a business. We can firstly use the asset basis to value a business. So quite interestingly, what we need to do from a shareholder's perspective is where we're going to directly take a look at the SFP. So here's the SFP for the sample company. So we've got the SFP for the asset, equity as well as the liability. So what we need to do from a shareholder's perspective is we're going to directly take a look at the equity figure of 67.2, and that 67.2 would be the minimum value of the company, because it shows all of its non-current asset, current asset minus the liability. So equity equals to asset minus the liability. So that the 67.2 shows the net figure, so net benefit that the shareholder can accept as a result of it. But this equity, 67.2, will need to be adjusted in some of the circumstances. Firstly, if you're going to buy the company, you bought the company. If you bought the company, those intangible assets needs to be realised. For example, we bought this company, its intangible asset includes the slogan. For example, the Nike company, just do it. Okay, fine. So you're going to capitalize that intangible asset related to the slogan. Here is one. You're going to adjust the equity figure, adjust the prices you're going to pay for. And maybe if the company is going to go bankruptcy, and hence, of course, the company is going to go bankruptcy, and hence what the company should do, maybe it's going to reduce the prices that I'm going to sell for those inventories. Rather than saying at 3.8, I'm now saying at $1. so decreased by 2.8. And as a result of it, the equity figure would decrease by 2.8, which would then give us 64.4. So what you need to do from a business analyst perspective is going to look at the SFP, using the equity figure as the minimum price you're going to pay for to those shareholders, and also you're going to adjust the figures within the SFP according to different situations. That's what I mean by asset basis. So asset basis is where we're going to look at the net asset of the company. Net asset is what I mean by equity, because the net asset is calculated using the gross asset, including the non-current as well as the current asset, minus the gross liability. So that will give us the net asset. We can call it the equity. The second way that we can value a business is where we're going to use the dividend valuation model. And we can call it as the DVM for short. So let's see how we're going to approach this then. So dividend valuation model. It equals to the dividends that the shareholder is going to receive divided by the required return by the shareholder. We can call it the cost of equity. So what does this actually mean is the dividend valuation model says that if we take dividend divided by the cost of equity, that would give us the price of the company. That would give us the value of the company. So let's put the figures in. So dividend, $10, cost of equity, 10%, so that the value of the company would now becomes 100. But what does that actually mean? It means that if the shareholder spent $100 in buying that company right now, if they require 10% of return in each and every year, so that they can get the dividends from this company of $10 in each and every year. So that's the logic behind this pro forma. But we can also argue that this is from the perpetuity approach perspective. It's simply because if we decide to get $10 of the dividend from the company, and our required return is to be 10%, so that it can give us the price of the company is to be 100, because we simply take 10 divided by 10%, giving us 100. So that's the way that we can value a business. We can see its dividends currently in the current year, and then we divide by what you think, for example 10%, so that you, from your perspective, what is the price for the company you're going to pay for. But dividend valuation model is basically focusing onto the dividend. So shareholders would prefer two things. So they would prefer dividends or capital gain. For those small shareholders in particular, they prefer dividends rather than the capital gain. Because they spend $100 out, they would like to receive the secured fixed amount of income in each and every year from a company, for example $10, rather than buying at $1 and selling at $10 and enjoys the capital gain, because that's too risky. So for most of the small shareholder, they prefer the dividend, and as a result of it, the dividend valuation model is particularly suitable for those small shareholders rather than the institutional shareholders who prefers the capital gain. So that's what I mean by dividend valuation model. But a question lies for that is that, well, if the dividend grows, for example, it's not 10, but maybe it rises up to 15, and as a result of it, the price of the company would change as well. And of course, that's a little bit advanced. Of course, we're going to cover that in the later course. But the simple idea behind the dividend valuation model is that it's mostly suitable for the small shareholders to value the business because they prefer the dividends. Okay? So that's the second way that we can do. Okay? And as you can see, one final point I'd like to make is that the dividend is the catch item. is not subject to manipulation by the accounting policy. So to some extent, this approach is the cash approach. It's the cash flow approach to value a business using a perpetuity approach from the small shareholder's perspective. The third way that we can use to value a business, according to your syllabus, is we're going to use the PE ratio method. So what do I mean by PE ratio? Let me just write that here. It's the P divided by E. So P stands for the price of the company divided by the earnings of the company. So earnings of the company means the profit of the company. So for example, if the earnings of the company is to be 10, but the price of the company rises to $170 per share. So as a result of it, let's just to make a figure. So 170 relates to the total price of the company, the total value of business, and the 10 relates to the profit after tax of the company. So the PE ratio now will become 17. So the higher the PE, the better the company will be. So why this is the case? If you think about it this way, you make a profit of 10, but you can sell it at 170. You make 10, but you can sell it at 170. Very high, isn't it? So that you can sell 17 times more than you actually earn. So that it can show that the company has a good future. Maybe because of the fact that in the future that the products of the company is quite popular, will be quite popular, so that the shareholder is willing to spend their money in buying those shares right now, even though they make a profit after tax of $10, but they can still spend quite lots of money to purchase a share of the target company. That's what I mean by PE ratio. But the question is, how are we going to use this to estimate the price of the company? So let's just have a look at the example. So if the target company has made a profit after tax of $20, and we are told that the target company is involved in the supermarket industry. Within the marketplace, there will be other competitive supermarkets. The PE ratio within the industry is to be 10. So, as a result of it, we are going to value a business. So, the value of the target company would be the PE ratio within the